Thank you for watching this video. Today we will be doing technical analysis on the U.S. stock market for the week ending Friday, December 25th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals is a proprietary trend-following and stock market risk management system. We're going to start off with a 4-year weekly candlestick of the S&P 500, and the S&P 500 for this week was down 17 basis points. And what we can see here on this chart is over here on the right, this kind of little cluster, right? This last 4 weeks or so of trading has been in a pretty tight range, and we're still very elevated above the 40-week moving average. And what's really interesting is looking at this. I don't know that I've ever seen this in 30 years of investing. Over 25 years of technical analysis work that I've done, I don't think I've ever seen a long-term moving average turn up as hard as this is right here. And you're going to see this in a couple of the charts today, but I just find this really interesting that, generally the 200-day moving average, right, the 40-week, it just kind of has a very smooth arc to it and a very smooth movement. But this move to the upside, again, I don't know that I've ever seen that before. So something to keep in mind, guys, that, the market has moved really hard here over the last few months, but over the last 4 weeks, it really has started to stall, and we'll see this throughout most of these charts today. There is some exceptions, so stay with me throughout the entire video. But this is something to pay attention to, right? As a technician, as somebody that's investing or trading, just understand that this real hard upturn at the same time the market is stalling, we may see some convergence here. In other words, pulling back to the long-term moving average, it's not unusual, as we can see here, right? You get years like 2017, which was a stellar year in the markets, where you don't pull back to that long-term moving average. But, you can touch it several times in most years, like we see here in 2018, 2019. Obviously, we broke below it and then, came back to it here this year. So just understand that the fact that we're so elevated above the long-term moving average, and we're starting to stall here, and I don't know where the next piece of good news is going to come from here, guys. Not to belabor this too much, and then we'll move on to the next chart, but just understand that, we know about the vaccines now, right? We know about the stimulus. Most of the known knowns are going to be factored into the market. So I do think the vulnerability here in the short term anyway is a potential pullback to the long-term moving average on all of the major indices, whether it's the S&P 500, the Dow, which we'll look at here next, or any of the other, especially the large caps. I just think the large cap area especially is very, very vulnerable to a potential pullback. So just kind of keep that in the back of your mind here as we go through these charts. The next chart that we're going to look at is for the Dow Jones Industrial Average. Again, this is a 4-year weekly candlestick chart. Green line still is the 40-week moving average, of course, equivalent to the 200. The Dow was up 7 basis points this week and closed at 30,199.87. So we are staying above the 30,000 level. But again, if you can see over to the right there where my cursor is moving, we have a lot of tight trading over the last 4 weeks or so in the Dow. Just above that 30,000 level, especially on the weekly. So we've had 4 weekly closes above 30,000 on the Dow, but we do appear to be stalling there. And again, look at how hard this 200-day moving average, the 40-week moving average in this case, is turning up on the Dow Jones Industrial Average. Again, this may be nothing, right? It may be just my observation, but that is a huge move, guys. Very, very rare. And again, I don't think I've ever seen it, right, where we've seen something turn that hard, one of these long-term moving averages turn that hard to the upside. So I just think it's worth watching. And again, this is happening at the same time that the market is stalling at the 30,000 level on the Dow, and of course right around that 3,700 level on the S&P 500. So definitely things we need to keep our eye on. The next chart that we're going to look at is for the triple Qs. Of course, the triple Q is the ETF that tracks the NASDAQ 100. This, of course, is also a 4-year weekly candlestick chart. The triple Qs were up 2 basis points for the week, so kind of some flat trading on the Qs, positive, but sideways for the most part. And you can see that the Qs are well elevated above their long-term moving average. So again, it just points to the vulnerability. It doesn't mean we have to pull back to that long-term moving average anytime soon, but it does make us vulnerable, okay? So just, regardless of what we're looking at here, guys, it's just important for us to understand as investors, as traders, what the risks are that are out there. And again, one of the things that I keep asking myself is, what's the potential next good data point that could come out that could drive these markets higher? I think most of the stimulus, the vaccines, most of the good news is baked into the market here. Will we go higher over the long haul? Of course. But in the short term, the question in the back of my mind is, what is going to propel these markets higher from here over the next couple of months? And I don't have an answer for that. The next chart that we're going to look at is for the IWM. The IWM is an ETF that tracks the Russell 2000 Small Cap Index here in the U.S., and this, again, is a 4-year weekly candlestick chart with the 40-week moving average being this green line here. The IWM was up 1.99% this week. The small caps have been on an absolute tear, especially since bouncing off their long-term moving average back here in September. Huge movement here, guys. So, after basically 3 years of sideways trading, you can see here from Q4 of 2017 until just a couple of months ago, the IWM, with of course some volatility, the IWM made absolutely no progress. The Russell 2000 small cap, that is was making a huge wide base, right? And as I alluded to, as I shared with my subscribers in my newsletter, the Simple Market Signals newsletter on a weekly basis, I kept telling them for many months earlier this year that if we are to break out of this sideways trading action, it could be very bullish for the overall market long term. And boy, howdy, have we done that over the last couple of months. That is a massive movement in a very, very short period of time after a very wide, long base. So the small caps, right, being the leadership area of the market over the last 3 or 4 months, that is a very positive thing long term. But in the short term, what I am concerned about is how stagnant the market has been over the last 3 to 4 weeks in the large caps, and how elevated the trading is above the long-term moving average, especially in the large caps. So the bright spot again is the small cap area. I do think that this is going to be a very important area to have exposure to over the next couple of years, 2021, 2022. It would not surprise me at all for small and mid caps to outperform large caps by a little bit, right, over the next few years. But that means it's a healthy market overall, okay? But the fact that the small caps were basing and didn't go anywhere for 3 years, that was a lot of pent-up energy. And this is why I believe we are seeing this huge movement in a very short period of time in the small caps. So this is a really good sign for the next couple of years. It's the next couple of months that I'm concerned about, especially with respect to the large caps. I just don't see what's going to be the next driving force, right, to drive the overall market higher in the short term. And we'll take a look at that here, especially so you can understand. We'll take a look at a short-term chart next so you can understand what I'm really talking about here. The next chart that we're going to look at is a 15-day, 15-minute candlestick chart of the S&P 500. So on this chart, each candlestick does represent 15 minutes of trading, and the blue line is set at 3,700. And what we can see is over the last 15 trading sessions through the 24th, which, by the way, was a shortened trading session because of that being Christmas Eve, we've seen some real sideways trading in the S&P 500 with, of course, some volatility, okay? And we're really just kind of stalling right around this 3,700 level. We've had a few days where we've traded above and closed above 3,700, but we've just been going sideways ever since we hit this 3,700 level on the S&P 500. So the market is acting kind of tired, lethargic, and again, in the back of my mind, The question I keep asking myself is what potential good news is out there that could come our way that is not yet factored into the market? And I can't come up with anything, right? We know about stimulus, we know about the vaccines. So I think most of the known knowns, as we say in finance, are baked into the cake, so to speak. Small caps, as we just looked at, they may continue to go up after basically going sideways for 3 years. So small caps, I think, are probably, for the most part, going to continue to go higher. But it's in the short term, what I'm concerned about here is the large cap space, whether it's, the S&P 500, the Dow, whatever. The large caps are just acting very lethargic. And of course, we've come a long way in a very short period of time. We are well elevated above the long-term moving averages on any of the major indices, even the NASDAQ 100, of course. So, I think it's going to pay here to be a little bit more cautious, but also please make sure you have a rock-solid risk management system in place to help manage your stock market risk now and over the coming years, because bond yields are way too low to help us anymore, right? And we've seen bond yields go up over the last few months. I'm not going to spend too much time on this, guys, but the markets have changed. And especially if you're somebody that has accumulated some wealth, it's going to be important for you to not only continue to grow that wealth, but also to make sure you don't give it back when the market does experience the inevitable corrections and bear markets over the coming years. So with that said, I'm going to tee up some more information about my proprietary model, which took me over 20 years to develop, because even with my level of experience and my expertise in this area, guys, I wanted something that was just stock market based, that helped eliminate opinions and emotion from the equation. And after 20 years of work, it finally came together for me. I call it Simple Market Signals, and I hope you'll pay very close attention to the balance of this video. Let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red. And what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how simple market signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the simple market signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this simple market signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the simple market signals model, there are three powerful indicators. There's the simple market signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in this Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file, all right? So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend, all right? So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right. And then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders, because it's probably hidden in there. All right. So you should get the automatic welcome letter and then the latest edition within the next day or two of your subscription. And then again, the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.